Right now, something incredibly important is happening in finance, and most people have no idea it's even being debated. Because buried inside a fight in Washington is a question that could decide who benefits from one of the most powerful financial innovations of the decade, stablecoin yield. And the fight is simple. Should ordinary people earn the interest generated by their money, or should the banks keep it? To understand why this matters, think about your savings account. If you walk into a typical bank today and open a savings account, you might earn something like 0.01% to 0.5% interest depending on the bank. That means if you save $10,000, after an entire year you might earn $10, maybe 50. Now here's the uncomfortable part most people never think about. Your bank doesn't just let that money sit there. They invest it. Much of that money ends up in US Treasury bills, short-term government debt that right now can earn around 5% interest. So while your savings account might earn you a few dollars, the financial system could be earning hundreds from the same money. For decades, the difference has quietly been the business model of banking. But stablecoins are beginning to challenge that structure. A stablecoin is a digital dollar. Coins like USDC are backed by real reserves, often things like US Treasury bills and short term government securities. Just like banks, those reserves generate yield. But here's where things get interesting. Crypto companies and some lawmakers believe that if stablecoins are backed by assets generating real interest, then the people holding those digital dollars should be allowed to earn some of that yield. Not the banks, not the intermediaries, the users. That idea alone has triggered a quiet financial tug of war in Washington. At the same time, platforms like Coinbase, Kraken, and other exchanges offer yield programs tied to stablecoin balances. Users can hold USDC or other dollar backed tokens and earn a percentage return. But that yield comes from underlying reserve assets, lending spreads, or structured financial products built around those digital dollars. And the full reserve yield is not always passed through to users. So the real question becomes controversial. Who should capture the yield generated by digital dollars? The issuer, the exchange, the bank, or the person holding the stablecoin? To understand the tension, consider how stablecoins function. When someone buys a dollar backed stablecoin, the issuer typically holds reserves in liquid instruments such as cash equivalents and short term US Treasury bills. Treasury bills pay interest. If rates are 4 or 5% and the issuer holds tens of billions in reserves, that creates significant income. Historically, issuers retain that income while users receive stability and liquidity. This structure resembles traditional banking. Depositors gain convenience and payment access, while banks earn yield by investing deposits into loans or government securities. But crypto introduced expectations of transparency and programmability. In decentralized finance, yield can be distributed automatically through smart contracts. Stablecoins can be integrated into systems that route reserve income back to users, transforming a non yielding digital dollar into a productive asset. That shift is where regulation enters. Legislative proposals such as the Clarity Act aim to define what stablecoins are and how they should be regulated. If a stablecoin is purely a payment instrument backed one to one by safe reserves, it may fall under payment or banking rules. But if it advertises or guarantees yield, regulators may treat it as a security or investment product. The distinction matters because payment tokens are meant to be stable and transactional, while investment products promise return. Once yield becomes part of the offering, compliance requirements increase and oversight tightens. Banks are watching closely because stablecoins already resemble digital deposits. They are dollar liabilities backed by safe assets. If crypto platforms distribute meaningful yield directly to users, they compete with savings accounts. Why leave money in a traditional bank earning minimal interest if a blockchain based dollar can earn competitive yield and settle instantly worldwide? That pressure challenges the traditional deposit model. Banks rely on deposits as low cost funding and earn a spread by investing those funds. If stablecoins grow large enough and distribute yield more transparently, they could draw capital away from banks. This is why some regulatory proposals suggest limiting stablecoin issuance to licensed banks or heavily regulated institutions. The goal is not only consumer protection, but systemic stability, preventing large shadow banking systems from operating outside safeguards. Meanwhile, crypto native firms argue that programmable money should allow users to access the economic benefits of underlying reserves. If billions in treasury bills generate interest, why should institutions capture all of it? Zoom out and stablecoin yield becomes more than an interest rate debate. It is about control over digital dollars, about whether banks or blockchain protocols define the next monetary infrastructure. As stablecoins expand into the hundreds of billions, yield is no longer theoretical. The future of digital dollars may depend not just on how fast they move, but on who earns what while they sit still. If this helped you understand what's really going on behind the headlines, this is exactly what we do here at The Breakdown. We take complex financial stories and break them down clearly, calmly, and in 5 minutes. No hype, no noise, just clarity. If you want to understand the forces reshaping money, markets, and global finance, subscribe to The Breakdown. And I'll see you in the next one.